Alrighty. Well, welcome everybody. Glad you could come. Today is Thursday. Wow, Thursday. And we are progressing through the year pretty quickly. Thursday, March 29th. Hard to believe Sunday is going to be the first day of April. Well, so today is the last trading day of the week, correct? All right. So we're going to talk about assessing the current market. This is for educational purposes today. All right. A little bit of an outline what we'll cover today. Who am I? I don't know who I am. Most of you have probably been on webinars today. I'm Dan Sheridan. I live in beautiful Chicago, home of the Chicago World Series champion Chicago Cubs. Is that how you? Good enough. Joking there. And I traded at the CBOE from 1982 to about 2004. Most of those years, many of those years, we were specialists. I worked with a small specialist firm on the Chicago Board Options Exchange. I worked with a couple good guys, many good guys, but John Nigerian and Pete Nigerian. I worked with them for almost 20 years. They're on CNBC Fast Money. Those two guys with all the hair on their head, those guys? Yeah. And in 2004, I started teaching retail folk strategies and risk management for bringing in monthly income, probably since 2004 on their live trades. And I've loved doing that. I've met a lot of great people and it's been a lot of fun. We're going to be reviewing last year and the current weather conditions of the last year and how it's affected retail options trading. And talk a little bit on a slide how we trade at Sheridan Mentoring and how we tweak things when the weather changes. Weather is another word for when the market changes, like it started to do in September 2017, and we'll discuss that, and has continued to the present. We'll talk about a complete portfolio and a plan, and then I'm going to go over 3 strategies, shorter-term strategies, and then we'll just talk briefly. We have a new course starting next Tuesday, and we'll go from there. Again, it sounds like John Thompson, a little bit of problem with sound, but I'm thinking most of you are hearing pretty good. Most of you, the sound is pretty good. I'm not doing the webinar today from my house like I normally do. I'm doing it from a little house near the water at Folly Beach, so the internet seems pretty good. So let me know if there's a problem. All right, let's dig in, and then we're going to look at some strategies. We're going to talk about the market and a few different things. All right, how we trade at Sheridan Mentoring when it comes to the world of option trading. There's many different ways. A lot of you trade. There's a lot of different ways. A lot of, or most of, as far as my methodology or how I trade, how I teach retail folk, has been from being down at the CBOE for 23 years or whatever and doing this stuff. And then tweaking things as you get into the retail realm. It's different trading. When I was in the pits, we traded 8 hours a day, and you had to trade every couple minutes. As a specialist at the CBOE, it's different. In the pit, there's 2 types of folk and 3 types of folk that are going in any pit. Like, for example, the SPX pit in Chicago. You'll have market makers, and those are just traders, and they just can, but the market makers can go in any pit they want, and they're basically motivated by where there's a lot of trading taking place, that they can go in and ideally buy on the bid and sell on the ask like a wholesaling function and make some money, and they have a better chance of doing that and taking no risk and making a few shekels every day if there's lots of trading. But there's the folk that run a pit, the folk that run most pits are called the specialist. That's what we were. And specialist is responsible for making the markets and all the different options. Market makers, if they want, they could just trade a few strikes, and maybe in the liquid near-term options, and maybe they don't want to take the volatility risk, so they don't trade anything over maybe 20 days duration. Whereas a specialist, not only do you have to trade everything, whatever the duration is, you have to give markets. Goldman Sachs comes in, you have to say, I'll pay 2, sell it at 2.25, and I'll buy 100 and I'll sell 200. So you're the responsible one. And also in a pit, any pit would be a broker. A broker is somebody like in the SPX pit, they have a few small brokerage companies. And one brokerage company that I know in particular, we've had them speak at our Chicago seminar probably for the last 3 or 4 years. They're the biggest broker in the SPX pit, and they represent many different brokerage firms. They'll represent Thinkorswim and some of the others. And so those are the 3 main characters in that pit. Would be your broker, your specialist. Those are the main stable ones. And then you have the market makers, but they're more fickle. Market makers will go where it's busy. If a pit's stopped being real busy, they go to the next pit, more opportunists. Okay, so how we trade at Sheridan Mentoring, number one, we trade the same vehicle. Every week, and you say, why would you trade the same vehicle? Why wouldn't you trade 30 different vehicles? The best way I could say it would be this: jack of all trades, master of none, right? And so the main vehicles that we would trade, probably the number 1 vehicle we trade is SPX. Say, Dan, why do you trade? Well, let me just add, Petru says it must be very hard to trade every 2 minutes when you're in the pit. Again, the function's different. Petru, who asked the question, as a retail trader, you guys can trade when you want to. When I'm a specialist in the pit, I am the market, right? I have my market. And so when Petru comes in and wants to buy 10 calls, well, who sells them to him? We do. So we're open for business. Our grocery stores are open for business. We have to trade. That's our job, right? Our job is to trade, take the opposite side of everybody, firms, institutions, the public, and try to turn it into something good. Picture yourself, Petru, in a kitchen. Like the Food Network, they had that, that show where they would compete cooking, Iron Chefs. So picture, Petru, you're a chef, and I come in and I bring the ingredients in and I say, Petru, here's your ingredients. You got 20 minutes, turn it into something good, right? Well, that's what a lot of times they did. If the volatility's low or the market's going up, the public may be buying calls. So I have to sell calls, maybe hedge it with another call, maybe hedge it with stock, and try to turn it into something good. So it was a fun game. It's difficult. It's easier being a retail trader, I think, in the sense that you have choice. The advantage of being in the pit when I was there was the markets were wider and you can buy on the pit, bid and sell on the ask. You say, Dan, why did the market makers, why did everybody leave? Why did, Tom Sosnoff and Scott Sheridan, why did they leave? Right? Why did they leave? Why did they go? Why did Nigerian and all those guys who started Trademark, why did they leave? Why did I leave? Well, let me tell you why. Electronics, a couple of reasons. There's 2 reasons why we left. a lot of traders left. Just like, why would a restaurant, right, stop being a restaurant? They're not making the opportunities out there, right? And so what happened was, number one, the market became more electronic. And when it became more electronic, the markets got tighter and tighter. And the main reason the main way we make money in the pit is buy on the bid and sell on the ask, like a wholesale function, right? And similar to a bank, but if the market's wider, if my bid is 2 and my ask is 2.5, I make $50 every time I buy it at 2 and sell it at 2.5. If I'm in a bid, and if I'm in a pit with lots of option contracts trading, I do wonderful. Agree? But as the market gets tighter and tighter and tighter, now the market, instead of 2 bid at 2.5, or the ask is at 2.5, what if it's 2 bid and the ask is 2.01? How do you make money? It becomes tough. So now the market makers are in the pit, taking risk, right? Taking the opposite side of other people, and they're really not getting compensated. So that was one of the reasons you saw an exodus of traders. It wasn't the edge. You weren't compensated for taking the risk. The other edge was, and I'm going to call this, if we were in a prison, right? I'm going to call this, the prisoners gain control of the prison. Dan, what do you mean the prisoners gain control of the prison? We were one of the biggest specialist units at the CBOE, Mercury Trading, where I worked with the Nigerian brothers and some other really good traders. And so one of the stocks that we were specialist in was Micron, MU, and it traded a lot of options. And I forget the point I was trying to make, but we buy on the bid and we sell on the ask. But it's the specialist's job to keep things law and order in the pits. Question says, do the specialists trade whole multi-leg strategies? Do they break it into parts? So as a specialist, we had to trade everything. If the brilliant quants at Goldman Sachs figured out something and they wanted to buy some weird spread that I never heard of, we had to trade it with them. If you wanted to buy calls, I had to sell them to you. If you wanted to do an iron condor, I had to do the opposite side with you. So we had to price our options, and a lot of the pricing was based on just supply and demand. If the volatilities were high and a lot of people were doing iron condors, we would start to lower some of the volatility levels as the sellers came in. But it was a fun job, but it's very challenging. Oh, the other reason besides the emergence of electronics, why we left the pit was, let me give you an example. For like Mercury Trading, which I was with, a lot of our overhead was covered by, we had our own broker in the pit. So we had a guy in the pit. So if you wanted to trade Micron options, whatever, a lot of the brokers would send their order into the pit. It would go to our broker. So he would execute the orders, and back then, maybe charge 50 cents a contract or $1. But believe it or not, we had some of the busiest stocks at the CBOE. Micron was one. Our brokerage, just on brokerage, might make some years, I'm just throwing this out there, $700,000 to $1 million on the brokerage. You with me? Just by accommodating all the people who wanted to play in Micron, just the brokerage aspect of it. Well, that covered our overhead easily, most of the overhead of the trading firm. And so what happened was, this is the part where the prisoners run the prison. Many years ago, somebody had a brilliant idea. I'm Thinkorswim. I'm Merrill Lynch, or I'm Petru says 700,000 with zero risk. On that end of it, on the brokerage end of it, we didn't have zero risk, Petru, because if Petru came in and let's say Petru was Goldman Sachs and wanted to buy 1,000 calls options at $2, and our broker didn't do a good job and missed it at $2, and it went to $3, were we liable for that? You bet your britches we were liable for that. So at times there could be some risk on that part of it. But the other thing is what happened is about 15 years ago, Thinkorswim, Merrill Lynch, all these firms said they came up with a brilliant idea. We have all this business, public orders, that the market makers want. They have to trade with somebody. You know what? I'm Thinkorswim. I'm going to shop it. What do you mean shop it? I'm going to go to the CBOE and say, you pay me for all the business that we give to you guys. Or if you don't give me some money for it, I'll take our business to the San Francisco Options Exchange or the Amex in New York. So what happened is our business changed dramatically. They made the traders pay for order flow, right? I mean, I still to this day don't know if it's legal or not, but they made us pay for order flow. Dan, what does that mean? It means now all this business used to come to the CBOE floor and we would trade with it. Merrill Lynch, Morgan Stanley, Dean Witter, Options Express, Thinkorswim. But now they say, you know what? We're going to charge $1 a contract for you to have this public order, because usually a lot of these public orders buy the ask and sell the bid. And they're smaller orders. So we're paying this. So now our overhead, we weren't able to continue our brokerage operation, but now our overhead, since we had to pay $1 a contract to get these orders to come, we were paying your brokerage firm millions of dollars. Well, who paid it? Do you think the CBOE paid it? Give me a break. They passed it on to the market makers. So basically, you're renting a barber shop on Folly Beach where I'm at, and they jack the rent up 10 times. Are you still going to cut hair? It's going to be tougher, right? And so you say, how do a lot of these brokerage firms make money, and how did they make money? Do they make money off they can make some money off your brokerage, right? But brokerage costs have got low. But how do they make money? They make money off the order flow, right? They make millions of dollars off the order flow. And how else do they make money? They had an article about this in the Wall Street Journal. Some of you that have portfolio margin accounts, do you realize that you're giving a gift to your brokerage firm of $1,000 a year because of ignorance? I'm saying that kindly. How do you do that? How do you think some of you with portfolio margin accounts are giving a gift of $1,000 that you could, a free gift of $1,000 to your brokerage firm? How do you think? Any of you know? How do you think you're giving a free gift of $1,000 for those of you with maybe a couple $100,000 sitting in your brokerage account? How do you think you're giving free money to your brokerage firm? Anybody know? Interest. So if you have, right, so you look at a lot of these brokerage firms, Thinkorswim and others, well, what will they do? They'll say, yeah, you ever notice at the brokerage firms that they say if you put more money in the account, they'll give you a better rate? Have you ever noticed that? If you put more money in the account, they'll give you a better, yeah. So what they're doing is they're saying, hey, Rick, put another $100,000 in. If you have $200,000 or $300,000 in the account, we'll give you, instead of $1 a contract, 60 cents a contract. Well, they're looking at your trading and saying, that's not a lot of money. But what they're making their money on is, they're going to loan out your money. They're charging you nothing, or they're giving you nothing for your long stock in your account, and then they're going to lend it out at much higher rates. So why am I saying this? Did you know those numbers are negotiable, right? But why do they do it? Because 99% of you aren't even aware of it, right? 99% of you aren't even aware of it, and you don't even, but you can, shop around, and if you were to shop around at a few other brokerage firms other than your own and see hey, I'm thinking of moving my money over, what could you give me for my long interest? And then you call your main brokerage firm and say, look, I've been shopping it around, you're giving me nothing. These two firms will give me this. I want you to give me this. I'm guessing they'll do it. Anyways, to make a long story short, could it save you $1,000 or $2,000? Yeah, but is that real money? I think it's real money, right? Right? I think that's real money. That you should have the choice of whether you keep. Anyways, we just talked about a few other things, but let's get back to this. But I think those are interesting things. All right, so same vehicle. We trade SPX. Some people trade RUT. And we'll trade some liquid stocks that trade a lot. Your Apples and some of these stocks that trade a lot. But I think, for me, I think SPX is the best vehicle to trade right now. Dan, why is SPX the best vehicle? Well, it's diversified. There's 500 stocks in it. It's pretty low volatility. It's lower, it's got low volatility, similar to a lot of your dividend-paying stocks, right? Johnson & Johnson is some of these. Many expirations, like Rick says, in the SPX, good liquidity. Now, can you trade baby SPX, SPY? You can, right? I like SPX. Not just the tax benefits, good liquidity, it'd be less commissions, and with all these, and you could always make a trade cheaper in SPX than having to do 10 or 20 contracts in SPY. We believe in, at Sheridan Mentoring, putting the same trade on every week. Every week. The nice thing is with weeklies, you can put on a trade that expires in, like today is Thursday. I could put on a trade today that expires in 7 days. I could put on a trade today that expires in 30 days. I could put on a weekly that expires in 50 days. Right? And so those are good benefits. Rick says he likes the European aspect of the SPX. Antonio says, what are the tax benefits of SPX? Again, I'm not a tax guy, but isn't it like 60-40? You could check with your accountant, but it's like 60-40. What is that, 60? I don't know what the 60 and the 40 stand for. I used to know that, but I don't worry about taxes. I know there's good tax benefits that you don't get in SPY. How we trade at Sheridan Mentoring, everything is a plan. We have a 4-step risk management plan on every trade that kind of guides us so emotion doesn't take over. And that would involve how we set up the trade. And that's what we're going to talk about a little bit today. How do we set up the trade in different weather conditions, different market conditions? Right now, we're in a different weather condition than we've been in most of the last 3 years. We're in a lot higher volatility. VIX is near 20, and we're in a range, right, between 2,600 and 2,800, but we're really moving around. It's a different weather condition. So how do we set up a trade? How do we set up the Greeks in different weather conditions? And then step 2 of the plan would be, what's my profit target and max loss? Step 3 would be when to adjust. Step 4, how to adjust. But we follow a very structured plan. Dino just mentioned, thank you, Dino, under Section 1256 of the tax code, profit and loss on transactions and certain exchange-traded options, including SPX, are entitled to be taxed at a rate equal to 60% long-term and 40% short-term capital gain or loss, provided that the investor involved and the strategy employed satisfy the criteria of the tax code. So obviously, check with your accountant on these, but you got some benefits there. I think one of the keys how we trade at Sheridan Mentoring, a lot of folk need to focus on is limiting the losers, right? If you talk to somebody who's been doing credit spreads for 2 or 3 years or whatever, they'll say, Dan, yeah, I was doing good until, you know, one trade really killed me. Well, what does that tell you if somebody gives you that comment? One trade really killed me. Either they didn't have a good plan or they didn't follow the plan. And so to me, this is the most crucial part. I think you have to trade consistently, number one. But number two, in terms of being a successful trader, you have to limit your losers to not that much more than you make, right? And that involves having a plan, right? You can't wing it. That's discipline. How we trade at Sheridan Mentoring, we tweak trades based on 3 criteria. So even though we may trade an iron condor or a calendar or a credit spread or a covered right or a cash secured put or whatever the strategy is every week, all the time, here's the difference. Based on 3 criteria, the levels of, let's say, whatever the product is, SPX, price levels, volatility levels, and the speed of the market, I may set up the trade a little bit differently, maybe use different adjustments, manage it based on weather conditions. Does that make sense? Just like in Chicago, am I going to drive a car differently in February after 8 inches of snow and ice than I am in August, 80 degrees? Yes, and I think that's where people fail as retail traders. They're looking for a system or something they can do all the time, but it's important to have guidelines, but you have to know how to tweak, how to drive in snow, how to drive in sleet, how to drive in ice, how to drive in good weather conditions and bad. And so that's important. What we stress is every month, how are we trading butterflies the same way today as we did 3 months ago? No, volatilities are higher. The widths of our butterflies are different. Our position greets and deltas are different at the beginning. Our durations are different, right? And so that's important, is how do you navigate? And that's what a lot of people don't know, right? If you're just following a system, when the weather changes, a lot of people are lost. Another way we trade at Sheridan Mentoring is just very few trades. I'm not a big proponent of putting 50 trades on, right? Unless you're drinking a case of Red Bull a day, you have a lot of time, and you're playing some loud Eric Clapton music during the day, and you're just all stinking, jacked up. I think most people would have trouble putting on and managing 30 or 40 trades. Would you agree? How many of you manage 30 or 40 trades? Any of you at one time? Or 20 trades? How many of you manage, do any of you manage 20 trades or more at one time? Yes, no one does, right? And I'm not saying somebody can't, but most people, it's tough to do, right? Some people said 8 to 10 max. So fewer trades, fewer vehicles. Stephen says, does that mean capital exposure? Does that mean bigger capital exposure in each? No, because here's the thing. If I'm an SPX, would you rather have a $50,000 position in SPX, or would you rather have 10 $5,000 positions in stocks in SPX, right? See what I'm saying? I mean, it's the same thing. I mean, it's a big diversified vehicle. Gary says, you don't believe in trade small, trade often. Let me comment on that statement. So there's a statement, trade small, trade often. Now, when I get new traders at a typical student that comes in Sheridan Mentoring, do we say trade small, trade often? Yes, but let me define what I mean by that. I'll have a student put a trade on for 4 months straight as he's learning. Every Tuesday, they're going to put on a 30-day iron condor. And I'm just making this up for you, but it gives you an example. So every Tuesday, they're going to put on a 30-day iron condor. Every Wednesday, they're going to put on a 9-day calendar. Every Thursday, they're going to put on a 20-day butterfly, right? So they're going to put on 3 trades, the similar 3 trades, every week for 6 months. Now, is that trading often? Often is defined by they're going to be doing like 3 trades a week, right? That's how I, different trades every week. Now, trade small, let's talk about that. If I say to Gary, hey, Gary, you're going to trade small, that's the best advice you can give someone, trade small when they're starting. So the only difference is, so I might have a student, if he's new, trading 1 contract on Tuesday an iron condor, 1 contract of a calendar on Wednesday, every Wednesday, and 1 contract on Thursday of a butterfly. That's a plan. And then as you get better, right, the only thing that's changing is you're going from 1 contract to 2 to 6 as you get more stable. So you can build that up and do 10 or 15 contracts, so you can manage a lot more capital that way. Because again, if your goal is as you're going, there has to be an intentional plan. In other words, if you just trade small, trade often, let's say your goal is $3 grand a month, or $2 grand a month, or 10 grand a month, or we have some students trying to make 20 or 30 grand a month. Does that happen? Is this like Dorothy and Wizard of Oz? As you keep trading small and often, this money appears? No, it has to be intentional. I'm intentionally going to try to make $3,000 a month. That's going to require a certain amount of capital. It's going to require, based on that capital, certain durations and certain contracts. So trade small, trade often is a very useful and correct phrase, right? No, it's a very correct phrase. It's just that when we're trading, and we trade small, trade often, meaning maybe 3 trades a week, but you have to increase your, but the goal is, as you build a foundation, you increase your size, right? Very simple, right? So it's a good motto. It's just, that's what I would mean by that. All right. Have $1 in a yield target every month. What am I trying to make every month? This has to be approached like a business. All right, I better go a little quicker here just for time. I'm enjoying talking to everybody, but I know I better I've gone 45 minutes, haven't gone through strategies. And then diversify durations and strategies depending on market conditions. All right, real quick, we'll just go through this slide and then we're jumping into some strategies. So how do I view things as a complete portfolio, whether you're managing a $10,000 options portfolio or $50,000 options portfolio or $1 million? Break it into 3 parts. A long portfolio strategies, and these would be covered rights, cash secured puts, long diagonals, like those are like covered rights without stock, where you would buy in the money options. Put credit spreads, out of the money put broken wing butterflies. These are all strategies that are neutral or bullish, that have either no risk on the upside or significantly less risk on the upside than the downside. So And I think you should always have a long portfolio strategy. These strategies over most of the last 3 years, except for the last couple months as we've been correcting here a bit, they've been like an ATM machine. Why? Because the market's gone up. But in the last 2-3 months, everybody doing these strategies are thinking, maybe I didn't know everything I know, or maybe I have to tweak these strategies. It's been an eye-opener, right? And then the income portfolio, these are strategies that generally will have higher yields than the long portfolio, but they're more characterized by you have risk in both directions. And so you're going to have more profit potential, but some risk in both directions. Iron condors, butterflies, calendars, double diagonals, and double calendars. And then your speculative portfolio, which most of you are familiar, would be doing things around earnings, long straddles, back spreads, vertical debit spreads, where if you think the market's going up, by a vertical debit call spread. If you think the market's going down, by a vertical debit put spread, or just buying calls and puts. But you have 3 parts of these portfolios. And, for most of my students, or most of the students in Sheridan Mentoring, they may do one strategy, 1 to 2 strategies from the long portfolio, 1 to 2 strategies from the income portfolio, and that's it. They may do a spec trade once in a while, and that's all they're doing, right? Whether they're trading $10,000 or $200,000, $300,000, $400,000 or more, that's basically it, right? Very simple plan based on probabilities and time decay and good risk management. That's it. We're not spending a lot of time trying to pick the top of the market or the bottom of the market or the side of the market or which way a stock's going. I don't know and you don't know, right? But we're very aware of, you want to be aware of the ranges of the market and some of the technicals and stuff, just at least so where things are trading at. All right, so let's start going in. Here's a price chart of SPX that I took in the morning, or took yesterday, so we're not that far from. I think SPX, last I looked, was 26.35 for rallying, but I took this when SPX was 26.18 yesterday. And as you look, this is one weather condition, right? I'll look at this as one weather condition. Let's start here. This is a weather condition in 2017, and this weather condition was most of 2016 and 2015. Say, Dan, what weather condition was that? The weather condition was maybe we had a slow uptrending market, low implied volatility during this period of time. We had maybe 150 to 150 point range in the SPX. Everybody was happy, right? The range-bound people were happy. The people putting things in the long portfolio covered rights were happy. Everybody was stinking happy because it wasn't moving enough to hurt you. So it's like you're playing Pac-Man level 1, you never got in much trouble, right? Right. So we had this low implied volatility, and it wasn't really trending much. During this period of time, which is basically from February through September, a good 7 months, it was beautiful, right? Slowly trending up, volatility's coming down. It's hard to lose much money, so people felt confident. Their self-esteem was up. They felt good with life. They didn't really have to know what they were doing much. And then what happened is you get the last quarter of 2017 here, you had a little bit different weather condition. And the weather condition was now, instead of in 7 months going up a little over 150 points, in 3 months, we went up almost 200 points. So it was going up fast. So that was creating some problems for the range-bound traders, iron condors, calendars, and butterflies. but it was also causing trouble for people with some bullish strategies. I mean, unless there was no risk on the upside, like just selling puts or put credit spreads. But people doing some strategies like out-of-the-money put broken wing butterflies, which are basically neutral to bullish. They had very little risk on the upside. Even they were struggling. Why? Because the last quarter of 2017, the VIX parked under 10 longer than any point in the history of the United States of America, right? So people who were doing short Vega trades like iron condors and butterflies, it was very difficult. Not only you weren't getting any premium on the iron condors or butterflies, but price move was going up fast and volatility was really parking in that 9 to 10 area. You with me? All right. And so here, people were fat and sassy, telling their neighbor to trade options. They're naming their kids butterfly and credit spread. They were giddy. They didn't know anything, but they were giddy. Here, people are like, hey, I still like the options business. It's kind of cool, but while things were moving around, I might have to learn a little more, right? They're not just giving me my money, right? And it's a little more difficult here because we're going up fast. And then things started changing here as we entered January. And January, to me, this was the best, to me, precursor of a correction that I saw, right? Again, I don't know which way the market's going, never have, never will, but was what happened in January giving me a really strong precursor that something could happen? Yeah. Don't they say, isn't there a rumor, or if it doesn't, it sounds good, don't they say like horses or animals can detect an earthquake or something, that they can hear the rattlings of the ground? Is that a myth, or is there some truth to some animals will get uneasy, or maybe they can hear the stirrings? And whether that's true or not, it's going to be used for my analogy here. But the point is, Dino says their senses are better tied. Okay, but if you look here, what happened here that gave me and many others an indication that things were changing a little bit? Well, we were still in a low volatility period, and this period here is mainly in January. And so in January, he had this really ride right up to the top of the mountain, and it was a very low vol environment. VIX was 9 to 12. But what happened is half those days were 18-point moves up. Now, 18-point moves up doesn't seem a whole lot today with the VIX at 22. But with the VIX at 9 to 11, that's a huge deal, right? That was over 1.5 standard deviation moves every other day. And you had it in one direction. And so when you see that speed, when you see 1.5 standard deviation moves almost every other day, gives you an indication, hey, it's like a volcano starting to, all the lava or whatever goes on up there, and it's starting to erupt, and it's going to erupt. And so to me, this January, and we did quite a few webinars during that talking about, we think there's going to be an eruption. Now, like everyone else, did I know which way it was going to go? No, but I thought there's a really good chance to have a correction, but it could have just as easily shot up. But I didn't think we were just going to stay, I thought something was going to happen. But it was based on the standard deviation activity. When I see that picking up, because when the price goes up, folks, remember, VIX isn't telling you VIX was only 9 to 12. So the VIX isn't telling you on a fast up move anything, right? You have to look at the standard deviations and the speed. And then as you can see, we hit the high on the 26th of January, and then, we started the correction, right? And we've been in this weather condition, and we've been in this unique weather condition the last couple months. And it's been range bound. We've had some ups, we've had some downs, but instead of a 9 to 11 VIX environment, we're in a, more 20 is kind of the mean, right? We're in that high teens to early 20s, and we're getting a range between 26 and 2,800. And so it's a little bit different how we're setting up some of the strategies, and I'll talk a little bit about that today, how we're setting them up, how wide we're going on these strategies, the credits we're getting, how we're managing them, what adjustments, what strategies we're using. And so it is important that you learn, folks, that you don't just say, you know, you do an Archie Bunker and you say, this is great, options now, they stink, it'll be like this the rest of our lives, I'm losing money, this stinks, forget options. No. You know what it's called? Stink and learn how to trade, right? You're going to have to learn, if you live in Chicago, you're going to have to learn to drive through the fall or the summer. That's different driving conditions. And then how do you drive in the winter, right? You need better wheels. You need heat in the stinking car. You need to drive slower, right? But a lot of people, if they don't have a plan and they haven't learned options and learned how to tweak these strategies, they're lost in these last 2-3 months, right? They're just like, the world's changed. This is a weather condition that happens when we have a correction. And this weather condition can last 3 to 4 months, right? Unless maybe if it turns into a bear market, but this is normal. Let me just say this in Spanish, English, and Swahili. This is a normal weather for a winter correction environment. You're going to get, you know, but again, folks, let me be clear. We've had a range here, have we not? Now, you say, Dan, my wife was so kind to me. My wife thought I was a great trader. We had a 7 months, only 150 points. My neighbors thought I was a good trader. I bought T-shirts that said I'm a good trader. And now I'm not making money. Oh! Well, get a life. Learn to drive in the winter a little bit, right? Trade smaller or back off a little bit. But if you want to trade, these are different weather conditions. But again, trade small. Learn. You'll get more comfortable with it. We've had a nice range here, 200-point range, but it's been over a couple months. Yes. Does a 150-point range here over 7 months seem better than a 200-point range over 2 months? Yeah, but vols are higher here, and you know, and that's what it is. Anyways, excuse my dramatics. All right, so here's an example of, we'll call this a 9-day butterfly, right? I'm just this would be an example of a trade. And we're looking at a butterfly. This would be more of a short-term trade. So I took this graph from Wednesday, right? And let me just, for folks that might have to leave a little early, I've gone longer today. I've already gone almost an hour. I'll probably go another 20, 25 minutes, but I just want to mention, check out our website. We'll be having a new online class starting next Thursday on short-term strategies. I think it'll be very intriguing because we've never had a period like this in the last 3-4 years of trading shorter-term strategies through a more volatile environment, a higher volatility environment, and there's a lot of differences in trading these strategies, shorter-term meaning 7 to 16-day strategies through this. So we'll be focusing on different types of butterflies, credit spreads, iron condors, calendars. It'll start next Tuesday, and I think, and it's going to be much different than a lot of the other classes on short-term strategies because we've never had this market condition. So how we're setting up the strategies is different. How we're managing them is different, and I think you'll enjoy that class. But here's an example of a 9-day SPX Butterfly. So the thought process would be if I did a 9-day, and this will run, it'll start on Thursday, just because that's when I'm going to be back next week, and it'll go Tuesdays and Thursdays. It'll be a 3-week class. It goes for $297. So it'll be 6 classes starting next Thursday, then Tuesday, Thursday, Tuesday, Thursday, and end on Tuesday. So here'd be a 9-day SPX Butterfly put on Wednesday, right? Yesterday was Wednesday. I took this snapshot, And so the idea would be every Wednesday I put on a 9-day butterfly, right? And the nice thing is if I put on a 9-day butterfly every Wednesday, so I have a plan, I would get this off before next Wednesday and put another one on. So what's nice is I can get 4 of these on and off in a month, whereas if I put on a 40-day or a 50-day butterfly yesterday, and I put a 40 to 50-day butterfly on every Wednesday, am I going to get it off in a week? No. So can I make potentially more money with these shorter-term trades? Absolutely. Why? Why? Because if I put a 9-day butterfly on every Wednesday, I'm going to get it off in 2-3 days, 4 days at the most. I can put another one on. So I got 4 trades on. If I put a 40 or 50-day butterfly on, I may be in it 30 days. So maybe I can get 2 off in a month, maybe not, maybe just 1. So the potential is to make a lot more money on much less capital, much less. If any of you have to leave, this will be recorded and Johnny will make the link available. Thanks for coming. For those of you who want to hang around, please hang around. If you have any questions as you're reviewing this, send me an email at dan@sheridanmentoring.com. I'd be happy to answer all your questions. Again, a week from today at 1 o'clock Central will be the launch of the short-term, how to trade a portfolio of short-term trades in a more volatile environment. You'll be able to join that and get information on our website. But if you look at this trade, I took this yesterday when SPX was at 26.12. So this would be an example of an at-the-money butterfly where I set up the short strike right at the money. Obviously, they don't have a 26.12 strike. So I bought one April 6, 25.75. So it was a 9-day trade as of yesterday. So I put it on yesterday, Wednesday, and expires a week from this coming Friday. And you could put it on every Wednesday, and you wouldn't overlap any trades. So I'm buying one 25.75 call, selling 2 26.15s, buying one 26.55. So the distance between the lowest strike call, and this is all calls, and the short call is 40. The distance between the short call and the highest strike call is 40. So we would call this a balanced butterfly. If these distances were a little bit different, I'd call it broken wing. In this environment, talking about tweaking strategies in this environment, whether I'm doing a longer term butterfly or shorter term, I found myself doing more balanced butterflies and a little bit wider. Why? Because the volatilities are higher. And I want to be just a tinge short deltas in this environment, which I wouldn't want to be 2 to 3 deltas short per butterfly if the VIX were 9 to 11, but as the VIX is higher here, 22 or higher, I'm comfortable with that because it gives me a little bit, the deltas, by being a little bit short, if the market goes down, that'll help me some, and to offset a little bit of the vega risk, volatility risk on the downside. Why do we have volatility risk on this type of trade? Because we're selling more time premium in the at-the-money shorts than we're buying in our in-the-money and out-of-the-money long options. So if the volatility goes up, we're caught holding the bag. We sold the ones with more time premium, and we bought the ones with less time premium. And so in this particular butterfly, I might have done it 30 wide when the volatilities were a little bit lower. But in the higher volatility environment, I can go a little bit wider. Why? Because I want a little bit more room. We're moving around more. You know, instead of moving 10 to 16 points a day when the VIX was 9 to 11, we're having 40-point days pretty rapidly. So this is a butterfly. This is your at the money. This is your graph at expiration. You make your most money at the strike of the short because your short time premium, your short options will decay a lot more than your long options will. And that's how you make money. This is a graph of how the position looks today. And as each day progresses, this will kind of morph into your green expiration graph. These are the Greeks. It's a positive theta trade. So every day you're making, theoretically, you're making some money if it doesn't move too much because you're going to make more on the decay of your short options because they're at the money, but then you lose on your long options. A couple questions related to butterflies. Fayez says, how the butterfly could make money in this environment when the SPX moves 40 points a day? And the answer is you're getting more room. You're paying less for butterflies now than you did when we weren't really volatile. You're getting more room on your butterflies now than you did a couple months ago. So if you're doing like a 40 or 50-day butterfly, you have more room. You can absorb those moves much, much better than you could when the VIX was 9 to 11, right? So you're getting the benefits when you're putting on a butterfly in this environment. How is it different than putting on a butterfly when the VIX was 9 to 11? You're paying a lot less if it's an all-call or put butterfly, number one. Number two, you're getting a lot more room on these butterflies. So it's a different, it'd be Fayez if you came from an area like California to Chicago with your convertible with bald tires and no heat, and when you came into the airport, they gave you a SUV with all-wheel drive, big fat tires. You know, you can navigate through that a little more. So you have a lot more room, and you can the butterflies that the market is presenting to you in this environment are able to handle some of the snow and sleet conditions of the 40-point moves better. Now, unless, just like in, are they more challenging on shorter-term trades? Absolutely. But, you know, I mean, it's equivalent of, you know, if you're putting short-term trades on now, and we're getting 40-point moves versus putting them on 3 months ago, you're getting 18-point moves in the SPX when the VIX was 9 to 11. They're similar, but that's what we'll be talking about in the class is just, you know, tweaking them and trading them through these volatile environments. Well, Stephen was just asking, how does this new class fit into the classes and learning and trading plans and all that? It fits in because it's a very necessary skill, learning how to navigate these trades through more severe weather conditions. They're much different. They're much different than any environment we've had in the last 3 years. All right. Another strategy, which, you know, as long as the VIX is, what's the VIX today? 22, 21, 20. You know, when the VIX is in the 20s, we're doing more short Vega strategies, iron condors and butterflies, and less long Vega like calendars and that type of trade until the VIX gets maybe in the mid-teens. So we're definitely tweaking things here. Here's an example of an iron condor, and the difference you'll see here, here's a 16-day iron condor. In weather conditions with the VIX is, in this example, VIX was 24 yesterday. And so in this environment, and this goes to answer one of the questions we just got, how can these things handle 40-point moves? Well, look, here's a 16-day iron condor. Put it on with VIX with the SPX at 2601, and I was selling I think in this particular one, the delta of the short call and put that I was using to pick the short strikes was about 13. And so with a 16-day iron condor, and I was picking the short strikes with maybe a 13 delta, On the call side, I was able to go out to the 27.25 for the short call. That's about 124 points out of the money. And on the short put, it's 171 points out of the money. So what's the difference between doing an iron condor with the VIX here at 24 versus 2-3 months ago when the VIX was 12? You're getting a lot more room from the current market on your short strikes, and this is a 16-day. If it was a 30-day or 50-day, you'd get even more room, much more. You're getting a little better credit, and you're getting a lot more room. So again, it's like getting an SUV when you come into the airport. But it is a little more difficult. It's like trading Pac-Man level 3 versus Pac-Man level 1. But again, remember, we've had a range over the last 2 months, and it hasn't been one way. So volatility's come down, then it's gone back up. So iron condors have been a pretty decent trade overall the last 2 months. And then finally, this is a strategy. I'm just picking a different vehicle. Rut's around the 1510. I think it's probably higher here. Here's a 9-day calendar. This was for a long time, and it still is a pretty good trade in the Sheridan community, a 9-day Rut calendar put on every Wednesday. But right now with the VIX a little higher, kind of backing off some of these until the VIX gets maybe in that, the VIX gets in the, I put VIX, I should have put an RVX number here, but until the VIX is like 15 to 18 or the RVX is a little lower, not as keen on the long Vegas stuff. But again, you can see here's a 9 versus 23-day calendar by 1 April 20, 1510 put. So 1 April 6, 1510 put for 9.5 debit. And you're getting about 35 points each way on your break evens. But again, if we put this on every Wednesday, we're looking to stay in this trade only a couple days. Right? It's $950 for one contract. We're looking to make about 7 to 10% on that. So if we're looking to be in the trade 2 days, these break evens of 35 points are for the entire 9 days. And so if we're in only 2 days or so, there's much less probability we're going to move 40 points in 2 days than we're going to move 40 points in 9 days. So again, it's all how you trade these things, right? And we're only looking, if I put this on a Wednesday, probably 50% of the time looking to get out by Friday. So even in this more volatile environment, we do have more room, but you got to be quicker to your toes. So anyways, if there's any more questions, I will hang in here. Didn't get a chance to go over these strategies as much as I would like to, but I'll answer some other questions as you have them. Would I adjust the 9-day calendar the same as a 30-day? I mean, when I'm doing these 9-day calendars, I'm going to limit myself to maybe one adjustments because of the short nature of it versus a 30-day. I may do a couple adjustments. The adjustments might be different, again, as Barney Fife from Mayberry, Andy Mayberry would say, nip it in the bud. The 9 days, they're going to be a different plan than a 30-day. Some of the adjustments may be the same, but the amount of adjustments and those types of things would be different. I'm just going to be less tolerant in a 9-day. All right. And also I'll be doing during the short term, during the class, we'll be doing, and you can see some information in the class, we'll be doing probably 4 strategies I'll be talking about. Iron condors, credit spread, or maybe more. Iron condors, credit spreads, calendars, double calendars, butterflies, and I don't mention it here, but I'll be talking about double diagonals, how to manage these. These are the class dates. These are the days we'll be meeting. We'll be starting next Thursday at 1 p.m. All classes recorded and archived, which is great if you're working. You can ask questions anytime. Class time minimum 1 hour. There'll be 6 classes. Here's the class cost, $297. Again, like all our classes, we'll be putting these on live trades every class, and we'll be trading them from beginning to the end to demonstrate them. Here's a rough agenda. In the last class, we'll be talking more designing a plan for $3K a month on $25,000. That's $3 grand, 3% per week. Because again, the concept of you're going to be able to put on and take off on $25,000, you're going to be able to put on your trades, take them off 4 times in a month, which you just can't do on 40, 50-day trades. So, folks, thanks for showing up today. And if any other questions I can help you with, you can email me, dan@SheridanMentoring.com. Look forward to seeing you 1 week from Thursday, managing these short-term trades in a little more volatile environment. It should be fun. See you later. Thanks.